now our top story. North American stock markets seem to be shrugging off the global IT outage that affected businesses and public institutions across the world today. And recently, of course, major North American indices have surged to new record highs. But our next guest, a veteran portfolio manager, is concerned about several things he sees in the markets today, and he's taking a more defensive posture on behalf of clients. Let's bring in our featured guest of the morning. He's John Zechner, founder and chairman of Zechner Associates. John, always great to have you.
Hey,
here.
Paul.
You are taking a more defensive posture after the markets have really blown the doors off so far this year. Why so?
Yeah, let me preface that a little bit. For the average investor, Paul, you got to say, the best long-term investment strategy is just to stay invested. You find some good growth stocks, an index fund, whatever, find what your allocation to stocks is that you're comfortable with and sort of stick that. Don't try to market time. There's painful lessons I've learned, we've all learned over periods of time of trying to do that. I'm always reminded of, I remember the first time I got up in front of a group of financial planners who sold our funds. I think it was back in 1985, and I wanted to be this sort of young, bullish, positive portfolio manager talking to them. And I remember saying, I'm very excited today. The Dow was at 1,500 for the first time. Yeah. 1,500.
Yeah.
Today it's 40,000. So, the quick math on that says it's a 9% annualized rate of return over that, 38, 39-year period. Mm-hmm. So, yeah, and that's the Dow. That's probably not even the best index or what you might do with better stock picking. So, from that perspective, yeah, stay in the market. But having said that, within that, 40-plus year period, I've seen, 6 brutal bear markets where the drop has been anywhere from 20 to 50%, where, one of them, it all occurred in one day, but where, people come to you after and then they say they're talking about redoing their retirement plans and things that are delaying retirement because of what it did to their savings. So I guess what I'm getting at there is I always watch for warning signs that say, we're not going to try to time the market, but maybe get a little bit more defensive in our holdings and our positions within the stock market. And I think right now is a time like that. And a couple of, the warning flags that I've got kicking up right now, Paul, it's just the general sentiment. You look at investors, they're all in. The household survey in the U.S. right now shows that the allocation to stocks is over 70%. That's a record. It takes a lot to move the needle on that. And at the financial crisis, we were in the high 50s. So that's really right at the top end. The American Association of Individual Investors, which shows that climate, is showing 45% net bulls. Again, a record, usually a market top at that point. Market being bullish consensus, 70%. So you have everybody sort of in and believing on this. So, that's one worry to start off. Then it's, some of the beliefs that are out there as well of, that there's I keep hearing there's $6 trillion on the sidelines in money market funds.
I was going to ask about that.
Which is a lot of nonsense, Paul.
Right.
That $6 trillion is not coming into the stock market.
Right.
A lot of that was money that was in low bank deposits getting no return at all. And when interest rates started rising, banks didn't increase the deposit rates, so people moved a lot of that money into money market funds and other short-term instruments. And I thought, yeah, it was logical because they wanted to get those higher returns. It didn't matter when interest rates were zero. So, to say this is ultimately going to come in and give a further push, that worries me a little bit as well. So you get the sentiment and the way the market's going higher. The bull run, we've sort of seen this last one from the lows last October, where the U.S. market's up 40% in that period of time. Earnings estimates since the end of October last year basically have gone up less than 1%.
Right.
So it's not higher earnings expectations that are driving this market higher. It's higher valuations.
Higher multiples.
Higher multiples. So I thought we're paying more for existing situations. Then on top of that, you've got a slowdown economically going on. You talked about the retail numbers earlier. I think the U.S. is starting to experience unemployment is rising. So, we are at that point in the cycle where you want to get defensive. And there's a lot of better value-oriented spots in the market. We added a little bit to areas like financials and some of the things, certainly defensive areas like, pipelines and utilities. You're getting a high dividend yield. You don't have much downside in terms of valuation risk, and you don't have as much economic sensitivity, as we get this slowdown. It's just taking a long time to work its way through. I'm talking, one other thing, too, is this long and variable lag of the monetary policy. We haven't seen an abrupt slowdown, particularly in the U.S. yet, because there was too much stimulus already in the system. And that's taken a while, that's held it up longer. But people are saying, okay, they're going to start to cut rates, and that's going to give a boost to the economy. Well, that's absolutely wrong. Monetary policy works better tightening than loosening. They call it the old, I learned this in economics in the 70s, the pushing on the string phenomenon works better, to be pulling. So the idea that suddenly, a cut in rates will stimulate the economy, that's going to take a long time. Because the housing market, take a look at that right now. The average mortgage rate in the U.S. is around 7% right now. The average mortgage outstanding in the U.S. has an interest rate of under 5%, which means no matter what, even if they start cutting rates, when these people start rolling out of these mortgages, they're going to be paying higher rates. So there's a lot of these things to just say, okay, take a little bit of risk off the table. We've done it. I've reduced some tech bets and other things like that, taken some of the bait out of the portfolio, still in the market, but not participating as aggressively as we were.
What would talk to us about market breadth? There's been this debate all year long about market breadth and whether it's broadening out or not from the small concentration of tech stocks. And in fact, we have seen quite recently the Russell 2000 index, a key measure of small cap stocks, rally fairly significantly. Yeah,
and you're right, and that's very well documented. How it has been incredibly narrow. The Mag 7 or whatever you want to talk about, 6 stocks, 5 stocks driving the entire returns of the index so far this year, and everyone's waiting for broadening. You got it a little bit more in the past 2 weeks, because tech took a little bit of the sell-off. I think a little of the change in potentially in the political polls in the U.S. that, pushing towards potentially, a sweep, a congressional sweep of the Republicans, and then, what they would do for business, which sort of drove the small cap because they're more domestic-centric. So domestic companies, those are small cap companies, they would get more of a benefit from that, more of the stimulus as opposed to the international companies. The idea that you're getting an interest rate cuts, more benefit for those smaller companies as well. The fact that these were cheaper as well. And on top of that, it's dollars. I mean, when you look at the size of, NVIDIA and some of these other, you into the trillions of dollars, it doesn't take much to move of that into these smaller companies to just have a great move in the index overall. So, yeah, whether it is the move yet, I'm still a little skeptical because those are economically sensitive. And, to the credit of these big tech stocks, they're expensive. They've dominated the run, but they've earned a bit of it because basically 100% of the earnings growth in the past year has come from those, top 6 companies.